Friends, the stock market sometimes witness a sharp fall, and whenever this happens, I receive the same question from the investors. Should I stop myself? My answer is almost always the same: no. In fact, history shows that some of the market's biggest gains have come immediately after its worst days. Now, think about this. Over the last few decades, 29 of the 30 best trading days in the Indian stock market happened during the period of major corrections or bear market. Now imagine what happens if you panic and stop your SIPs after a big fall. You may miss exactly the days that have the biggest impact on your long-term returns. Now let's understand this with a simple example. Suppose you're climbing a staircase. Just because you stumble on one step, would you turn around and walk back down? Of course not. You continue climbing because your destination is still ahead. Investing works exactly the same way. I agree that market corrections are uncomfortable, but they are a normal part of wealth creation. Friends, when markets fall, your SIP doesn't stop working. It actually starts buying more units at the lower price. And when the markets eventually recovers, those additional units often becomes the biggest contributor to your wealth. This is why experienced investors don't fear about the fluctuation. They understand that temporary declines are the price what they pay for long-term returns. So the next time the market falls sharply, don't ask, should I stop myself? Instead, ask yourself, has my financial goals have changed? If the answer is no, then your investment strategy shouldn't change either. Friends, remember, the market recovers. History has shown us that time again and again. The investors who stayed disciplined during the difficult times are usually the one who benefits when the recovery begins. And remember, your financial journey deserves the right guidance. Follow me to keep learning, growing, and saving smarter.